Yeah.
It sounds like Mr.
Yeah. Like, got through a few of these. And one overhead I threw. Okay, that was accidental. Yeah. It was accidental.
How would you act?
They're not as aerodynamic as you think. So, I know you're thinking, well, wait a minute. Is that what the Wright brothers flew? All right, so.
How do you
Huh?
how do you act?
Because it was there.
Well, there's that one time in the last grade where he was falling off the building, but the device was falling slower than him, even though it's technically more aerodynamic, it's falling faster.
Was it a 5 year?
Yeah, but
It was
All right, so
things fall.
let's go over the Great Depression really fast. And the thing about depression is we do have to go over a couple terms so we know. And a depression is not like a technical, and we'll come back to some of the review that trickle down. But there's not like the depression is not like a technical term, meaning, these 5 things happen into depression. It's more just long-term unemployment, long-term stagnation. And really a depression is, it's basically kind of just to the eye of the beholder. And so by all argument, you guys lived through a depression. From 2008 to 2012, it was a depression. Long-term high unemployment, stagnant wages, but nobody wants to call it that because we had the Great One. And that one lasted from 29 to, you could say 39, but it really did not fully end until 40 or 41. And here in 2012 is when it ended, but they call that the Great Recession. So let's find what a recession is. A recession is another economic term kind of created in the 20th century, at least as a technical term. But this is an economic downturn, and what it is that the size of the economy. Now today we do the overall size of the economy of goods and services sold as we call it the GDP. Some of you might know that term, the gross domestic product. Back then they called it the gross national product. So we'll stick with the GMP because we're talking about the 30s here, but it's 3/4 of dropping GDP. I don't know why I drew it like that, but I think you know what I mean. That makes no sense. 3/4 arrow down. But 3 straight quarters of an economic decline. And that is the precise term. So the GDP shrinks, or GMP here. And so most people think the stock market, the Great Depression started with the stock market crash. You've all heard of the crash, know what it is, but in reality, the recession began probably at the end of 28. But the crash happened in October of 29. Yeah.
I'm kind of confused still. What does the 3/4 down there mean?
It means that 3/4 always go down, 4 up. It's simple physics.
3/4.
3 straight quarters of economic decline. So 3 straight quarters, how many months? 9. Each year has.
Can't multiply.
Well, I'm sorry, my math is
I understand.
Because math is boring.
And then when we get to R,
very complex.
and yeah, it sounds kind of, the quarters that be made up with more modern way to do economics. No one talked about quarter years, quarters like that for a quarter year before 1920. Just like nobody mentioned for a pregnancy what a trimester was till 1972.
Me too.
That was kind of made up on the Supreme Court. Little things like that. It's like these weird little things you have that came about. But so back to quarters, 3 straight quarters. That is a term, and some people will call what you lived through the Great Recession because they didn't want to call it a depression. But in reality, the recession ended during Obama's first year in office. But high unemployment and stagnation lasted for another 4 years. Even though we've been on straight economic growth in some way for 9 years, we have this constant trend. It's almost exactly, who knows when it'll end? Roll the die. Yeah.
So this recession, should we call it slightly less great?
Yeah. They call it they called it the Great Recession, the one you lived through, but I prefer the name for the one you lived through as the Lesser Depression. So, one more term you need to know, and that's a panic. And that's the financial panic. A financial panic, a financial disaster. And what it is this. Think about why they call it a panic. And would lead to a credit freeze, banks don't want to loan money, banks shut their doors. If you put money in a savings account, let's say, or even buy a stock or bond, you get a piece of paper in return. that has all the New Deal laws on it. That's not weird. But also it will have how much money you have in the bank. Or if you buy a stock, it's a stock and it says, okay, this piece of paper is worth so much money. And we call that paper value. You're not holding money in your hand. You say this piece of paper is worth money. So you have $1,000 in the bank, you get a piece of paper saying this is $1,000. That makes sense? Or you have a stock that's selling for $1,000, that's $1,000. It's not really $1,000, it's just a piece of paper that says you have it. But people buy and sell this like it's money. Because there's a market for it.
People want the stock.
And that's going to happen. You'd be shocked how often that happens to this day. But why this is a panic is, let's say you have the $1,000 piece, piece of paper that says $1,000 because you put a deposit in, and the bank shuts the door in 1929. I know. What's it worth?
Nothing.
And what is your feeling when you realize I thought I had $1,000 and now I have nothing? What feeling do you have? Panic. Or if stock values begin to tumble and you don't know what this piece of paper is worth anymore, that's panic. And that's where you get the financial panic. You see a lot of pictures of panics, and there'll be like a guy with a push broom pushing pieces of paper to the gut. And that's a very classic financial panic. In fact, the short-term loans for businesses that you do today, businesses make millions of dollars of loans every day. They call it the paper market. And the first time you hear that, what are they selling, reams of paper? No, it's just that short-term little loans. It's a little piece of paper.
How much does a single piece of paper like? How much is a single piece of paper like?
That's your job for the weekend.
10 cents.
10 cents according to the library.
Well, that's different on that.
Yeah.
But you can buy a ream piece
I
of
mean,
paper.
it cost of being from
So how much-
What they're doing is you're paying a lot more to deter you from printing a lot. So you don't print 1,000 pages.
I'm gonna do that now.
All right, so those are the terms. So we have the Great Depression. And let's go very quickly then about what the 20s were like. There's a couple things we have to get about the 1920s economy. Now, we talked about these things, and there was a growing economy. The GNP, did grow. There was a lot of production, high productivity, but a couple things we need to know. First off, number one, this was a time of massive technological change. Technology. New machines were coming out for production. And so what we're talking about is this technology, when it comes right down to it, you're making better machines. What do we call that? What are the means of production? This is capital. So there's all kinds of capital advances, especially early on in the 1920s. Now what's happening is they're replacing workers with machines. Or at least threatening. Or a better way to look at it is the economic term, as I mentioned this one time before, it's called productivity. And that's the amount that one person can produce in a day. Or in an hour, they measure it differently. I'm not talking like how hard they work. I just mean, so if you have 1,000 workers, how much do they produce in that day? And you divvy it up, you're going to divide by 1,000. And so, productivity was going up pretty high, at least in the middle of the decade. It started to drop dramatically at the end of the decade. What's the time of the biggest productivity growth in American history after the Industrial Revolution began? Obviously, the beginning of that would be, anyone know when the biggest? You're on there, yeah. From the late 40s to the early 70s. The biggest productivity growth. Huge productivity growth.
So right
After the war through the 70s. And that's also, well, no, it's technology. Vast technological changes. But there's also the best economic time in American history. Yeah, big productivity growth. We're really low productivity right now. Really, 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 really low. But that could change. You know, if low unemployment stays for a while, there'll be an incentive to replace. Because low unemployment, wages go up, there's an incentive to replace workers with machines. Does that kind of make sense? If unemployment is really high and wages are low, why get a machine? Workers don't take that much.
So would you measure productivity off the capital or still the workers?
No, productivity is just purely per worker, how much one worker produces.
But if the machine replaces the worker, then you
Yeah. So let's say a machine replaces 10. You replace 10 workers did a job, built this pen. You make a machine, now only one person produces it. You count that one person, their productivity went up by 10 or 1,000%.
Because the machine produce more, and so then we divide it by less work.
And so to make
Worker has more.
one person do the work of 10.
Yeah.
It doesn't quite work up that dramatic, you know. A huge productivity growth, like huge productivity growth is like 3%. What I just told you is very unrealistic, but it's easy for the math.
What about farmers?
Farmers, same deal. Remember the mechanical reaper?
Well, yes, it's like.
And you'll see it again.
Did they say that, or at least like 10 workers? So that'd be.
That really hurt small farmers. So, technology, and the thing about it is that, here's the thing. Remember the thing about capitalism. Capitalism, there's good and bad things about the system, you know, like everything else. And they take care of risks, encourage innovation, but who gets the profit? Whoever owns the capital. And what we had here is technology was going up, yet too, wages were stagnant. Wages were stagnant. For the vast majority of Americans, wages either stayed the same or went up very gradually. In fact, there's argument that the bottom 40% of the wages actually dropped. And this should be familiar, because that's what it is now. And of course, then again, we're nearing full employment. Maybe that might be shifting right now. You know, so a lot of things are happening right now. Problem is, when it's happening right now, you can't really tell the future yet. So with that, wages are stagnant. But here's the deal. The economy was growing. We already said that. So where's the money going? The top 1% was getting 93% of the wage growth. So all the money's focusing on top. Part of the reason why the recovery was so slow during most of the Obama administration, and that started to pick up at the end of his, and then it's kind of going on to today. From 2010 to 2014, 1%, the top 1% got 100% of the wage growth. Now that's sliding. So some people say it might be as low as 80% now, so we'll see. But here's the point. The money's going there. And you know, they would argue, and I think for good reason, you know, hey, we have the capital, we took the risk, we get the money. But for the long-term health of the economy, this has serious problems. Serious. And here's the thing. We have very low inflation this entire decade. That's going to get even worse at the end of the decade. That meant wages stayed low, prices stayed low. And in real terms, wages kept dropping. Now, do you know what I mean when I say real terms? What does it mean? Real terms mean what? You know? Yeah. So in real terms, because we're talking about the value given, that's in relationship to inflation. So real means according to inflation. So the prices were going up slightly, and wages were going up about the same. I mean, think of it this way. Let's say your wages went up by 2%, but inflation was 3%. Did your wages go up? No, it buys 1% less. That's a drop in wages. So right now, this last month's report from the Labor Department, wages went up by 2.6%. And that's really high for the way the economy has been for the last 30 years. But inflation's about 2%. So how much did wages go up in real terms? 2.6. Yeah, it's better than nothing, but it's not like the 1960s where it's booming at 4 or 5%. So
At least it's a gain.
but it is a gain. And that does mean that the wages are going up, but you got to do it in real terms. I like that story we saw in the video about the 20s. And he said, you know, for $1, you could buy a loaf of bread and a gallon of milk. Remember that guy withdraw all that? Well, you know, that's about $1 could buy about $1 then could buy what $20 today could buy. So could you buy all the same thing and get change today? So inflation is kind of hard to figure out, or really to look at. The median wage when I was born was $7 a year, and I made that. Actually, it's about $7,000 a year. And today, what's the median wage? Family income.
Around 40,000.
It depends where you look, but it's about 54,000. So, do you know what I mean by median? Not average, that's the middle.
Yeah.
That's a little more accurate than average isn't very accurate for wages. Because you know, if you take, let's say, what does anyone have a job outside here? Where do you work at? So you take your daycare wage, you add your wage along with Bill Gates' wage, and then your average is going to be, yeah, like 500 million a year, won't it?
Oh, yeah.
Is that an accurate representation of your average? Okay, so one, technology, two, wages, and so this is an issue where there was a lot of gain, but most of it on top. Remember though, this is economic policy. This was economic policy for trickle down. Three, the farm economy was in absolute shambles. The farm economy was in shambles. The median yearly wage by 1929 was about $760. You don't even know, I'll just give you an idea, about $760. Think, you know, different era, which by the way is below the poverty line then. Anybody want to guess what the average farmer's wage, median farmer's wage was? Farmer's earnings, farm, huh? Not quite that, but about 2 cents. You have this entire class of people, a huge percentage of the population, much bigger than that. We're talking over a quarter of the population still, are barely making. Prices tumbled for farmers. In 1921, they went down by about 90%. But the problem is, and we got to talk about, machines are now replacing it. So one farmer working their land is not near as efficient as a huge farm with tractors. Or think about today now with combines and everything else.
Yeah.
And they're just going to start going under. This is a huge drag on the economy. My great-grandfather on my father's side, they lost their farm in 24 during this big craze. Near Papillion. So my dad was actually born on that farm because they couldn't afford a hospital. That was unimaginable. And then they lost it in 40. And so, farm economy. And next, but we do have this growing consumer economy. I mean, this is a radical shift. A lot of you guys answered this on your test. I was happy you did that, talking about the expansion of industry. Some of you talked about the farm economy, talked about cars, everything else. That was great. But now the economy more and more is relying upon average people to buy stuff. And it's personified. In fact, it's going to be focused on two main things. Automobiles and the production of these. And then, I have all these new consumer electronics. Okay, I know that's relatively modern term, but think about like refrigerators and washers. No dryers yet. But I know, I'm going to blow your mind away. Electric irons. Whoa, pretty cool, huh? Actually, compared to the way they used to have to do it, which was just literally light them on fire. But no. You get a piece of iron, you put it in your stove with a handle, use that. Huh? That's how I did it. No. Just go iron random things with it. So that, but the one that really personified all this new industry, all this new stuff was radio. Radio was the biggie. Radio. That means I'm not. Oh, okay.
Yeah.
But this is not okay. I see what you're doing. So with that, think about cars though. Think about what it takes. Now, there were virtually none of the infrastructure, anything for cars before 1920. And then all of a sudden it just exploded. What do you need to make a car? Everything, right? And by the way, where do you get rubber from?
A tree.
Literally, it grows on trees. It's the sap of the rubber tree. And it grew wildly in the Congo. You know anything about King Leopold and what happened there? Yeah.
It grew.
And then they could cultivate in other areas where there's rainforest. So Henry Ford would carve out, when I say carve out, he bought and then basically enslaved the people working there. A big area of Brazil he called Fordlandia. Literally, it's called Fordlandia for rubber. But like a place called French Indochina, it's gonna have a lot of rubber. Actually from the country of Vietnam, nothing to see there. But the point is, and then you get this sap, And then a guy named Charles Goodyear came up with a way to vulcanize it. Remember Goodyear? Heard of that name?
No.
But that would basically cure this sap, and so it's something you could use first for raincoats. It kind of makes sense, but then you can see what a big deal that is for tires. You need this whole infrastructure for just getting the rubber there. Yeah.
What were tires made of before?
Wood, steel. Now they started using rubber for tires in the 1880s, but it was really expensive. But as they produced more, rubber's not cheap. Plastic actually comes from petroleum. Well, speaking of that, don't you need petroleum? So you have that. What? You happen to just get lucky and you hit the ground and all some stuff squirts up and you put it in your car.
Yeah.
Is that how it works?
Yeah, I would talk.
That's not bad.
By the way, in Borneo, up until about the 1950s, it was so pure coming out of the ground in Borneo, they called it light sweet crude. It was so pure they could put it right into the turbines of ships, right out of the ground. Smoked a lot. Got a lot of imperfections, but it would like catch fire right there in the ground. That's pretty wild, I think. But you have to find it, drill it, and that's an entire infrastructure just to do that. Pipelines or railroads to get it to a refinery. And actually, gasoline was a byproduct they just burnt off. It was trash. Until they realized how volatile that would be and used that to make an explosion, an internal combustion engine. And for some weird reason in the United States, we call it gas. But I'm pretty sure, I know science is partially made up, but gas is like, and don't say that in, let's say, Britain. And walk up and say, where's the gas station when you're desperate, your rental car is nearly out of gas and you gotta drop it off at the airport. And the guy looks at you and goes,
That's a very specific
yeah.
reason.
Yank. And I said, no, I don't know, I need petrol. And he's just like, so funny. No, literally, we had to get, and I was like, just a little bit frazzled. And I said, where's the gas station now? And he just, then he laughed. He was, they're very polite there.
What do you call it?
Petrol. It's petrol.
That's petrol, like.
Yeah, for petroleum. Petrol.
Everywhere.
And that actually makes more sense, but well, in reality, who cares, right? And so, I mean, you think about it, yeah, it's our continent. I mean, it is, Yeah. But, so, this whole infrastructure, and not only that, you refine it, and by the way, all the scraps and junk, from refinery, that's where plastics come from. It all comes from this. And artificial food coloring, flavor, aspirin, petroleum for the healthy body. And well, now what? So we have refinery. What do you need?
Cars.
Cars, refinery. Okay, good.
You need fuel stations.
Yeah, gas stations, that whole infrastructure to do that. All that had to be created. And how do you charge for that? I mean, this all had to be created. And not just that, we just went with rubber and gas. You need high quality steel. It can't be heavy stuff because it makes it too heavy to use. What else do you need? Glass, and it can't be any glass because if it chips, it'll shatter in your face. Bad for driver morale. And leather for the seats and wood. What else? Mirrors. Yeah, and by trial and error, they would come up with that, even though there were some mirrors on some of the carriages, but still. Think about other electronics and what else? Yeah. Oh, yeah, and a way to tax them and to regulate and control. I mean, we go on and on all the things you need to make a car, but we're not even done yet. Now we have a car, we have a gas station, we have a refinery. What do we need?
Engineers.
We got the engine. Roads. They didn't just appear. And here's an amazing thing that happened. So you have companies making cars and want to profit. We have oil companies making gasoline and want to profit. But they need roads. And who built them their roads? Yeah, the government, the people. What huge help for business. There'd be no car company if the government didn't make roads. They couldn't afford to make roads. And that's just huge government aid. We're going to make you roads and we're going to clean them and fix them. Clean them, why not? and repair them. So all that infrastructure, that means you can cement, blacktop, can we go on? Think about all that, and then snow plows and everything else. And then what else? Repair, tow trucks, all had to be new, right? Also, heck, people are driving, they might get hungry. So you need restaurants on long roads. And what else? They might be driving and maybe they'll get tired.
Hotels.
A hotel for motorists, a motor hotel, motel. That's where motel comes from. No, no. Motel is a motor hotel.
Making moves.
It's a hotel for motorists. Motel.
My mind is.
Thank you, 1920s. And let's say people quit buying cars. You see how that's going to ripple to everywhere? In 1931, Ford actually shut its doors, which is just unbelievable. Quit making cars. Anybody want to guess what they make in Toledo, Ohio? Cars. Firestone is there. What do they make?
Tires.
The unemployment rate in Toledo was over 50%. Wow. Do you see how this can ripple to everywhere? And think about it, not just the people who work in making tires. So they're laid off because no one's buying tires anymore. So they're not going to the stores and buying things. They're not going to restaurants and buying things. And for that matter, you have less people paying taxes. Did I say restaurants and buy things?
Yes.
That's kind of funny. Restaurants and eat. That's where I do my shopping. Restaurants. And if people aren't paying taxes, how do you pay for teachers or workers, any government workers? You see how this can ripple to everywhere. And so you have an economy that reliant upon just a couple things, it can be a real problem. Now there's some good things about it, because boy, you really know when things are bad. We're much more diversified, so it might be harder to tell. And you can see the same thing too. I didn't put up there construction was almost as big. But I did this because I wanted to really get the idea of how it relates to technology. There's huge construction boom, and you can imagine what happened, because you saw it in your lifetime. We had a construction recession's not strong enough, a word, absolute crash in 2007.
When did they start putting radios in cars?
They started pretty early on, even though radios were huge things. But in the late 1920s, you see the first radios. But there's a big deal, like General Motors started putting them in. You could buy a purple car with a radio.
That actually sounds
Actually,
awesome.
you know, if you only could get black or pretty, it's like, that was pretty cool. Purple was like a really popular color for cars.
Does it remind you?
So, one more thing, so these are the elements of the economy. I just want to get a few things there. And what we have, though, is what everybody talks about, though, is, and what they remember is that speculation. And we got to get to this stock market crash. The stock market crash. Because what we have here is, well, was focusing on top. Actually, wages stagnated and sales began to drop. And remember the boom-bust cycle, when you have the boom and it goes to overproduction. And what do people always do? Prices start dropping, they produce more. You saw the same thing, and this happened in 2008. The economy started to go bad. You need more details, just can sense it. Sales are down, profits are down. And it leads to kind of like, well, but we can still make money in the stock market. And so you get this kind of boom in the stock market. That's going to happen while the recession is going on. Because people are trying to make up the difference by gambling in the stock market that they're losing in other places. You'll see it in 29, you'll see it in 2008. In fact, you saw it in 1893. You know, this is not an unusual thing. By the way, though, it gives you the illusion that things are better than what they are. That's a big thing. So, in the stock market, what do they invest in first? The first real big speculative boom in 26, 27, and that crash? Where? The biggie. Florida, but all over. But then we have the stock market. And there are a number of ways to tell the size of the stock market. But you think about on the stock market, people are buying and selling shares of stock. And there are other things, we can talk about bonds or different kinds of things that called trust, but we're going to just focus on stocks. Shares of company. And originally, you thought stock was, you bought a stock, and then you sat, were patient, you own that little piece of the company, and when it made a profit, you got your little piece. What do they call that little piece of the profit? Say it again. Yeah, that's a dividend. But in this speculative craze, people didn't want to wait for that. They wanted money now. That's that pick those apples off that tree. And so they were borrowing money, buying stock here, expecting to do well.
Sell high.
Yeah, they would pay back their loans and make a profit. And so that's what's happening. People are borrowing money to sell stock. And what makes stocks go up in value?
People buying stuff.
Partially just demand builds on itself, but originally the thought was, okay, people will buy stock if they think the company's going to make money. You know, they have some new innovation or something. Buy that stock in that purple car that GM was selling.
Or radio.
Or the radio, yeah. And so, but pretty soon it just becomes demand. It becomes a mania. Wow, everybody's buying it. Let me buy it. And companies are all realizing, boy, we're selling stock. And so they say, okay, we're making a lot of money. How do we know if a company is making money and therefore trying to sell their stock that way? They tell you our revenues are going up. We're selling more every day. Our costs are lower than our revenues, and we have all this profit. Do they tell the truth? No. There were virtually no regulations on it. So companies were making up how much money they made. They were making up balance sheets. In fact, they were selling stock in subsidiaries of companies that didn't exist. In fact, people were selling stock into companies they didn't even own. It was crazy. If you ever been to look at the stock market and watch the traders, you'll see how that can happen. It's just insanity.
I'm surprised this one's don't break out on the stock market.
What's that?
I said I'm surprised this one's don't break out on the stock market. This is crazy.
And you ever see the commodities market in Chicago? Absolutely insane. It's amazing. I don't know how they do anything. It's only just a few people. They're just yelling about selling, and it's just crazy. Passing papers around, say, I bought, I sell, I buy, I sell, and they go back and they settle up. And it's unreal. But prices start going up. Now, how do you figure out how big the stock market is? Because some stocks go up, some don't, right? Now, there are a number of different indexes. And what they do is they take a ratio of the amount of stock of certain stocks sold and the price. So probably the most accurate at that time was the New York Times Stock Index. But it relates pretty close to the one they still use today, even though it's not near as accurate, but I'm going to say it now. You've probably heard the Dow Jones or the Dow. And basically what they do is they take a ratio. They take 30 big companies. So this is their sample set, 30 companies, and they do a ratio of stocks, the number of stocks sold and the price of stocks. Comes up with a ratio. And today, because of a combination of a number of things, inflation, companies are bigger, computers, that ratio is a lot higher. So what is it today? Like 24,000 something? Is it a 20? Is it a 26 now?
No, it's almost.
It went up. It went down the other day. It went up. We're kind of in a bull market right now. Yeah.
So you said like the Dow Jones consists of like majority of the big,
About 30. Yeah.
the big markets. But
No,
what about
companies.
But what about like Amazon that's not in the Dow Jones? They're very large.
Yeah, I know, and that's actually a really controversial thing because the corporation that runs that, the Dow Jones, is a corporation, and they decide to 30 companies. So it's a big deal when they take one out. So not every company's in it. So, and you just said it doesn't have all those other companies. So it's not very accurate. It's not an accurate measure. It just gives you an idea. But we just use it for an idea. Yeah.
You just name a couple of the companies inside.
General Motors, Microsoft is on there.
And what do they do with the companies?
They come up with a ratio of the amount of stock they sell and the price of stock. Now, in 1921, the Dow Jones was about 40.
Yeah.
It's a different world, right? In 27, when the real estate bubble popped, it was about 106. In February of 29, 193. In September of 29, 393. More than doubled. Now, what that meant is people are buying and selling more stocks. It just gives you an idea. Speculation has gone up. What's happened to the price of stocks? No, they're all going up. People are buying like mad. Think about demand. I want. And people just assume we're buying stock. We're not making as much money here, so let's buy here. And this bubble grows higher and higher. And it was during that summer when people began to realize sales were much lower than we thought. revenues, they're not telling the truth. And once you think some companies aren't telling the truth, but you don't know who, what does that lead to? Yeah. The first real crash, the first big hit happened in that September of 29. Big hit. Stock market went down. But then it rallied. Because think about it, if you're a speculator, two things. First off, if the price drops, what are you thinking?
Buy some more.
Buy. And number two, because how long is this boom going to last?
Forever.
Forever. Stocks will go back up because that's the way it's supposed to be, right? We call that a sucker's market. You're a sucker to buy in. And the thing about a sucker's market, how do you know when it is a sucker's market and not just a smart move?
Yes. You're a sucker.
You know long after the fact. I'll give you an example of somebody who sold out that September and got rich. He got a lot of his money from bootlegging, by the way. The patriarch of the Kennedy family, Joe Kennedy. He sold and kept his wealth. If he would have waited a couple more weeks, I wouldn't have the, there wouldn't have been a President Kennedy the way it happened. So, that's just an example, but most didn't. And then, here's what we get. October 24th, Black Thursday. And what happened here, stocks tumbled again. And this time, people didn't trust anybody. At first, 2 months ago, we're all getting rich, yay! Next, I don't think you're telling the truth how much your company is worth. No one believed anybody. They started selling. In fact, they sold so fast, it kind of froze the market. Today, we have automatic stop. Computers will automatically stop the market if it falls too fast. Because of what happened here, it happened in 1987 too. It fell so fast that nobody knew what anything was worth. It was dropping faster than people could keep track of. And no one could keep accurate information. If you can't get accurate information, but you know I'm losing money, what do?
Well,
That's the term panic. And so, with that, Black Thursday, then they had what's called a bank holiday. And a bank holiday was 4 days of no financial trading. Banks shut their doors, basically to stop the panic. President Hoover went on television, TV was literally just being invented. Was it Philo Farnsworth in Idaho? Huh? Went on the radio twice and told people the economy is sound. Everything is fine. Invest. The fundamentals are solid. The Secretary of the Treasury went on the radio. This was unheard of. To tell Americans, as his job as Treasury Secretary, the American economy is strong. Who was the Treasury Secretary? Mellon. Guess what Mellon was doing in secret?
stealing money.
Maybe in a way,
So.
he's telling his brokers to sell, while he's telling the American public in his job as Treasury Secretary, everything is safe. You don't have to panicky sell. There's somebody who forgot what his job was. No. There's somebody who knew what his job was, but cared more about himself. And the era of the individual. And so, on the 29th, when they came back, this is where we get the biggie, Black Tuesday. And this is the biggest single day drop in the stock market, a crash. Start out good. How did people get stock information back way back in 1929? Huh? Pigeon. They yelled it across the street. Okay, telegraph lines? Telegraph lines, if you send information down to, and it could be a pretty amazing little device called a telegraph or a teletype machine that actually take the signals on the telegraph line and type out words. So that'd be a way to send stories on. But obviously, you don't want a whole story. You just want a little bit of the company and its stock price. That's why if you look at the stock market, you see only 3 letters for all these companies. That's from that, so you can type it in real fast. And the telegraph would go to this teletype that they called a teletype that they called a ticker tape. And the ticker tape print out this long, skinny piece of paper. And it just went from A to Z, alphabetically, all the companies trading on the stock market. And had 3-letter initial and the price. And so let's say you're a stockbroker in New York City, but you're not in the stock market. You don't want in that craziness. You're just reading the stock. And a normal day, it just comes through and everything's okay. But let's say you're looking on the 29th and it starts out, okay, it's good. Price is going up, the pan is open. Let's say, well, prices drop, prices drop, prices tumbling. And that's what you're doing, this little piece of paper. And then it started dropping so fast, over 1 million shares were traded in 3 hours. It was dropping so fast that they're typing in, it froze the telegraph lines, it overlooked them. So think about it. You're, oh my God, oh my God, oh my God, no more information. Ah! Absolute panic. That's when you got the hair on fire panic. By the way, what do you do with all that ticker tape? All the little thin, long pieces of paper.
Wait for a parade.
Exactly. So now Fifth Avenue, the Avenue of the Americas would have all the skyscrapers when they started doing this beginning of the 20th century. So like when Charles Lindbergh went there and 400,000 people came out to see Lindbergh, remember Lindbergh, the guy who flew across the Atlantic? They had a ticker tape parade. So the skyscrapers, they take all this ticker tape and drop it out the windows. So all those nice little streaks going down. It's a very, very ticker tape parade. That's what it comes from. Today, they still have them, and they now just make a long piece of paper. They call it ticker tape. Even though they obviously don't use that machine. Even though it'd be kind of cool if they did.
Streamers?
Well, but they're long, skinny piece. Huh?
Wait, streamers want to get-
Yeah, I know, but these are called ticker tape.
Okay. It's gotta be expensive.
And so, people lost 16 million in paper value that day.
Whoa.
You get what I mean by that? Their stock they thought was worth something and it turned out to be worth this. And the tumble lasted for the rest of the year. In the next 3 months, get this. I know the numbers just weirdly happened to match. People lost over 16 billion in paper value in 3 months. And where did that money go? People thought they had this much money. Also, they only had this much. Where did that money go? Gone. Just gone. And you can imagine how that would ripple to everything. What happened to banks? Get this down. 10,000 banks shut their doors in the next 6 months. And banks that survived, you think they're loaning money now?
Nope.
Production dropped by 1/3 in factories in 3 months. They just quit producing goods. So the recession was beginning, then the panic. And we saw it here. In your lifetime, it was on September of 2008. And I can still remember this. It was always, they called it the paper market froze. And that was just the break. Literally, like someone hit the brakes on the economy. And it took years to recover. Yeah.
So how much would that be worth today? $16 million.
Multiply that by about 20, so 320 million. 320 million, I mean. That's a 2-year salary.
Oh,
If it was monopoly money. So, really fascinating. A couple things then. How bad the economy went down, we'll see in the video. In 1932, the worst year of the economy, the worst year of the Great Depression, the GDP down by 1/3. So basically, contracted. The money supply down by 1/3. By the way, if the money supply drops by 1/3, what do we call that phenomenon? What, the value of money? That's deflation. And lastly, unemployment. In some areas, is high at 50%, but on average, about 25%. You see figures from 22 to 32. It's really hard to figure. What caused this? So I'm just going to tell you one of the causes real quick. So the causes of the Great Depression. And the video, I can tell you how bad it was. The video does such a good job. That's why, I said, life was bad. Oh, yeah, I agree. So stay. Causes of the Great Depression. Do you like the green pen?
Yeah. No. I see your mind.
No. I feel like writing the board today. Number 1, overproduction. Underconsumption. Or oversupply under what? Yeah. Just want people to buy stuff. Cars were the biggie. You can imagine what cars were. In 1925, Henry Ford's making so much money he doesn't even know how to deal with it. At the height of the Depression in 1931, Henry Ford gave his son Edsel $1 million in gold. Two things about that. First off, $1 million in gold, which heck of a lot of money. That's just here's some gold. Along, and also built up his own village. Secondly, yes, his son's name was Etzel. And Ford would make an Etzel in the late 1950s, considered to be the worst car ever made in nearly bankrupt Ford. Has anyone ever seen an Etzel? They're shockingly ugly. They're so ugly, it's hard to even wrap your mind around.
Are they as bad as they?
How do I spell THAT? Get it, since you said that. Sure, yeah, that's all. EDSEL. That's it. Yeah,
Are they as bad as?
he named all his kids Etzel. Is that George Foreman?
That is, yeah.
That's right. George Foreman named all his kids George Foreman.
Doesn't he have a girl too? How long was Ford closed?
About 8 months. By the way, the workers then, when Ford shut down because nobody was buying stuff, were the workers lazy?
No. They just built a ton more cars.
There's no jobs. Yeah, what did Ford call? Lazy. Did you get a job? Not my fault. So, with that, the bell rang. So, we'll finish up the causes, then watch the road to rock bottom. You will like the road to rock bottom. That's another one that's really good. And, what do you got for us in it?
Yes.
You know, the Gremlin might be, the Gremlin's not the word fancy car. Look up the Pacer.
Yes, I know.
But the Etzel really destroyed Ford. What did you see in Etzel?
My Ford made.
Oh yeah, it literally is like a toilet bowl. Oh no.
Big guy.
It's like, hey, cars they have on this guy and get a bunch of money to get a car.
Food. It's so bad. They didn't actually make any day. It was just hilarious.
I like how you want to cherish that moment forever.
Oh, take a picture, yeah, I remember this day. For the rest of my life.
Yeah. Good luck, Dave.
It's a lot.
I gotta admit, that's the first time I've ever heard those words spoken coming into my classroom. You'll hear all kinds of interesting things.